Hey everyone, Coach Investor back to another video for today. So let's talk about the 4 dividend-paying companies that are worth your while for the month of October, where I did a video about the 4 growth stocks, best stocks to buy in the month of October. That was in the top right corner. Of course, I am just talking about 4 companies. There are plenty of great dividend-paying companies out there. Do let me know which one you have been picking up or which one you own in your portfolio down in the comments below. So the first one I want to touch on is Nike. Now, Nike just reported earnings, so we're going to go over some important numbers there. But I do want to show you, since this is about dividends, yes, the dividend yield here is just 1.42%, so not as high as the others on that list. But as you can see, the dividend growth, annualized growth in the last 10 years is 12.47%. That's pretty nice. Which basically means if you bought shares 10 years ago, the dividend payment was 12 cents. We are now sitting at 34 cents. So maybe the dividend yield right now is just 1.42%, but those that have been holding this stock for quite a while have seen their dividend payout increase quite a lot. Now, overall, this is the overview of the company. Market cap of $146.3 billion, forward PE of 25 times. Year to date, the stock is down 17.50%. At the time of making this video, that's the day after they reported earnings, the stock was up 6.6%. Now, the analyst estimates for fiscal year 2024 with regards to sales, you can see that revenue is expected to accelerate in fiscal year 2025 from 3% to 8.2%, and then in fiscal year 2026, 7.75%. With regards to EPS, just like with many other companies out there, that is expected to grow faster than revenue. So for fiscal year 2024, 14.4%, then 25, 17.64%, and then fiscal year 2026, 14.39%. Now looking at their latest earnings report, so first up, the dividends, those were $524 million, that's up 9% from the prior year. They also repurchased $1.1 billion, that's reflecting 10.5 million shares retired as part of the company's 4-year $18 billion program approved by the board of directors in June 2022. As of August 31st, 2023, a total of 54 million shares have been repurchased under that program for approximately $5.9 billion. Now, with regards to the overall numbers, revenue increased just 2%. It was also a slight revenue miss, but a big beat on earnings per share. So revenue increased 2%, cost of sales also increased 2%, and so gross profit here, the change is 2%. Gross margin is a bit down, 44.2% for this quarter compared to 44.3% same quarter last year. Now, what is interesting here is effective tax rate for this quarter we're at 12%, same quarter last year 19.7%, so keep that in mind. Net income decreased 1%, but earnings per common share basic was 95 cents, that's just up 1%, but was quite a beat from the analyst expectations. Then if we go and look at the different areas that they operate in, so North America, totally they were down 1%, footwear is down 2%, apparel is down 1%. Then if we go to Europe, Middle East and Africa, the total there increased 8% year over year, footwear is up 12%, apparel is down 1%, and equipment is up 27%. When you look at China, you would have thought that with all the scary headlines, the Chinese economy is not doing very well, etc., etc. Well, it's up 5% year over year, so it's doing even better than North America. Their footwear is up 4%, apparel is up 7%, equipment is down to 4%. With regards to Asia Pacific and Latin America, that's up 2% year over year. So of course you might say these numbers are not that impressive. Why was the stock up so much the day after? Why is it in this list? Well, while revenue numbers is not as impressive as you would think looking at the stock's reaction, I still think it was a positive view. Looking at the macro environment, you might have thought that the company would have been hit much harder, especially if you look at the stock action. It was basically disregarded by the whole market. So we've seen a positive reaction, especially at the bottom line. Some positive comments during the earnings call as well. Positive numbers out of China. And don't forget, next year there's also the Euro 2024 in Germany. There's also the Olympic Games in Paris, so expect Nike to have some presence there and to maybe create some content around that, brand awareness, etc., etc. Be on the lookout for that. So that was stock number one. If you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not. We're well on our way to reach 30,000 subscribers. So thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, stock number two is a stock I personally own. I talked about this already in the past. You either love it or you hate it. And that stock, that company is called Verizon. So Verizon has a market cap of $136.25 billion, forward PE of 6.9 times, a dividend yield of 8.21%. If we look at the dividend growth here, consecutive annual increases 19, and then annualized growth here in the last 10 years, 2.39%, which means 10 years ago you would have gotten 53 cents, you're now getting 65 cents, but of course the stock's performance has not been great at all, and that's how you reach an 8.21% dividend yield, which in my opinion is one of the better ones that you can get there. Overall, the shareholder yield here is 5.61%. Why is that? Well, because you have to decrease 2.40% for the debt paydown. Now with Verizon, I already covered the earnings report, so let's just go on the infographic here. Total consolidated revenue, $32.6 billion, declined 3.5%. Adjusted EBITDA of $12 billion, that's up 0.8% year over year, and adjusted EPS declined 7.6%. But the big positive here, of course, there were questions about whether or not the dividend is safe, whether it was for Verizon or AT&T. Well, cash flow from operations in 2022, $17.7 billion. We're now at $18 billion. CapEx is basically down from $10.5 to $10.1 billion. Free cash flow increased $800 million to $8 billion. And then dividend paid, you can see they can cover the dividend with that free cash flow. They also said during the earnings call, the cash generation, as I said, is strong, gives us optionality and supports a much improved dividend payout ratio. Our capital allocation priorities are unchanged. We said first we would invest in the business. The second priority is our commitment to the dividend. Our third priority is to delever, and you'll see us be focused on that. And then once we get to the leverage metric of 2.25, we will consider buybacks at that time. They also said we are on track to achieve our forecasted $2 to $3 billion in annual savings by 2025. These savings, in combination with the completion of the $10 billion C-band spend, position us to generate strong cash flow and continue to invest in our business and pursue dividend increases as we execute on our capital allocation strategy. So in my opinion, right now, I think we've passed the stage of extreme noise. It's just now a question of seeing results materialize, and you'll see the stock react accordingly, which is why I do still believe that this 8+% dividend yield is a no-brainer right now. Up next, company number 3 is a newer position in my portfolio. I've added a couple of weeks, I think a month or so back, and that's a REIT, but a very special one. It's Vici. Now, Vici currently has a market cap of just under $30 billion, a forward PE of 11.3%. Year to date, the stock is down 6.56% and has a dividend yield of 5.7%. Now, in the last 3 years, you can see the annualized growth is at 9.44%, so pretty good. Meaning if you bought back in 2018, you would have gotten 16 cents for the dividend payments, and now you're at 41 cents already. A pretty strong dividend paying company, even if it's pretty young. Now, when you buy Vici, you get a pretty diversified business portfolio. You get 54 properties in 15 states and Canada, 60,300 hotel rooms, 4.2 million square foot gaming space, and 66,000 gaming units, 6.7 million square foot meeting and convention space, 450 plus food and beverage outlets, 50 plus entertainment venues, plus 4 golf courses, and around 500 retail outlets. So I would say a pretty special portfolio. Now, being located in Las Vegas, of course, it's pretty special. The Vegas boom is still going on. In 2024, you will have the Super Bowl there as well. You also have Formula One happening in a couple of weeks. I mean, you can see the numbers here. Visitors in 2022, 39 million. Convention visitors, 5 million. Direct visitors spent $45 billion, which results in a total economic impact of $79 billion. 8.3 billion in gross gaming revenue, an all-time annual record, and 11 out of 20 largest hotels in the world. Now, if we look at their latest numbers, total revenue increased 35.5% year over year to just under $900 million. AFFO attributable to common stockholder increased 25.7% year over year to $540.4 million. They updated the AFFO guidance for the full year 2023 to between $2.13 to $2.16 billion, or between $2.11 and $2.14 per diluted share. And in case you missed it, they made a couple of announcements here. They expanded the international footprint in Canada with Century Casinos. They completed the acquisition of Rocky Gap Casino Resort, and they announced the expansion of partnership with Canyon Ranch. Now, of course, with REITs and real estate in general, now that we got the message that probably rates will be staying higher for longer, these types of stocks right now are not performing very, very well. So keep that in mind. You're not going to buy these stocks because you want short-term results. No, you're buying these stocks because right now the stock itself, the price, is down, is being pressured by a high interest rates environment, which you get the benefit of getting a higher yield right now. Once the economy is in a better place, the stock should be moving up and you'll just continue to generate that cash through the dividend payouts. Now, I explain this because the next one is also a REIT, a pretty popular one, a monthly paying one as well. It has been in the spotlight because the stock here has not been doing very well either, and that's Realty Income. Year to date, the stock is down 18%. In the last 3 months, it's down 15%, has a market cap of $35.4 billion, forward PE of 40.7 times. Now, the dividend yield is now 6.16%. You get a payout each and every month. If you look at the consecutive annual increases, written here 23, annualized growth in the last 10 years, 4.23%, which means 10 years ago you would have gotten dividend payments of 18 cents. You're now getting those of 26 cents. Now, more recently, they announced that they are investing $950 million in the Bellagio Las Vegas at $5.1 billion valuation. And as we've just seen, Las Vegas, a pretty good place to own some property, especially those luxurious ones. Now, why should you buy this REIT? Well, Realty Income is the global leader in a fragmented net lease sector. It is growing its international presence. It's the fourth largest global REIT, $7.6 billion in European portfolio, 303 assets, approximately 9 years remaining lease term, and 38 industries. If you look at the strong dividend track record, 29 consecutive years of rising dividends, 637 monthly dividend declared, 103 consecutive quarterly increases, and it's an S&P 500 Dividend Aristocrat Index member. If we want to look at their portfolio, who their clients are, etc., we can do that as well. You just have to scroll down a little bit until we reach that right here, diversified high quality portfolio. So this is the top 20 clients as a percentage of annual contractual rent. Yes, number one here is Dollar General, has been getting a lot of attention lately. We covered that on the channel as well. Link will be up in the top right corner. If you want to look at the industry diversification, percentage of annualized contractual rent, 11.11% sits with convenience stores, then 9.9% grocery, 7.1% dollar stores, then 5.9% home improvement. You have restaurants, quick service and casual dining, health and fitness, automotive service, and general merchandise. Basically, very well diversified. Now, with regards to the property type diversification, the majority of it is in retail, then industrial, gaming, and others. And so I'll repeat myself, right now in the high interest rates environment, yes, these types of dividend paying companies, especially REITs, will be under pressure. But maybe that's an opportunity for the long-term investors, those that want to build up a dividend-paying portfolio that will last for years and years to come. Those are the types of companies that you would like to buy when there is a lot of pressure, when these companies are still healthy and paying a nice dividend yield. Of course, do share your thoughts down in the comments below. Do you hold a dividend-paying portfolio? If so, which are the companies that are in there? Let me know down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.